Hello, welcome back, everyone. Thank you for watching this video podcast. And we have some great topics to discuss. And my name is Seewing Yi from the Yi Real Estate Network. And my co-host is Richard Advani from Guaranteed Rate Mortgage, who is a investment loan agent who does loans on all 50 states on behalf of real estate investors from all over the country and overseas as well. And Richard Advani have been in business more than decades, more than 10 years, and he have done very successful, a lot of business, and not only help people do loans, he help people advise them from the big picture, wealth building strategies. So he's very hands-on. He provides amazing consultants. So welcome, Richard Advani. Thank you so much for your time. So should we dive in to the PowerPoint?
Yeah, let's dive right in.
All right, let's get to it. The first headline is, the title of my video is 2024 is the year of the quote unquote reverse housing crash. What do I mean by that? You're going to find out if you tune in toward, watch toward the end of this video. All right, big picture. Back in 2021, we're getting some amazing mortgage interest rate of 3%, which is a historical rate. Consequently, we have a historic pandemic year whereby the average we're getting throughout the country around 30 to 50 offers per house. At that time, only 2.5 years ago, the median price of a home nationwide were around $250,000. All right. Now, fast forward to this year, 2023, we have seen mortgage interest rate hovering around 7.5 to 8%. And yet, we're still getting 3 to 5 offers per house. And the Federal Reserve tried to break housing, but they cannot do it. Housing market is very resilient. The price continues to maintain itself. But we're not going to go into the details why, but suffice to say, even currently, nationwide, we're still getting more than one offer per house, sometimes 3 to 5 offers, sometimes more, depending on the specific location. Basically, the demand are still higher than supply of inventory. Go figure. Okay, so therefore today, the median price of a single family home around, let's say around $400,000. In order to, because of the high interest rate, a primary homeowner needs about $114,000 of salary to qualify to buy a house with financing. As a result, the home affordability is at a 40-year historic low. However, here are the concerns that I have. If and when the mortgage rate comes down to around 5%, we will trigger 5.3 million more buyers to flood into the housing market. So what are the consequences? Here are my triggers. My triggers are moving forward beyond this year into 2024 and even beyond. Look, I've been doing this for a long time. Okay, I've been helping investors for more than 20 years. Richard, you same way. Human behaviors is very predictable. If and when the mortgage rate comes back down to psychologically 6.99%, we will see increasing demand. The supply of inventory is still going to be very limited due to the lock-in effect. The next psychological numeric behavior, or the second trigger, is 5.99%. This trigger this rate will bring even more demand for our buyers getting off the sidelines. And then the final trigger is 4.99%, the psychological rate buyer. And then frenzy will break the housing market. And we will see a housing crash up, UP, not down, reverse housing crash. All right, here's the summary. Then momentarily, Richard, I'm going to have you pick up the rest of the presentation momentarily, but let me finish a couple more slides. The year 2024 and even beyond is the year of the quote unquote reverse housing crash. Once, and if we'll know, no one can predict the future. We don't have a crystal ball. If the mortgage rate comes down at 6% to 5.5%, potentially we may see 20 to 40 offers per house nationwide. And we will probably see home appreciation of 10 to 20%. And the new median home price could be around $450,000 to $500,000. And the new income of a prospective buyer needs to qualify to get a loan. The salary needs to be around $145,000. So therefore, again, this is just my crystal ball. Okay, it just we may see a historic 100-year low home affordability crisis, or 1,000-year, doesn't matter. Okay, prehistoric affordability low, and then I predict it will be a demise of the middle class, and we will see a epic rise of renters nation. As a real estate investor, Richard and I, we consult, we guide our real estate investors, our mom and pop turnkey real estate investors to buy out of state for years. Richard does the financing, and I do the guiding, mentoring, and consulting. Investors buy now. Okay. However, as much as we would like to have a very low mortgage rate, here's my thought. I do not want a 5 to 6% mortgage rate, and neither do anyone else, because it'll break the housing. I say it again. Although investors who have current rental properties now and risk investors that are in a process of pulling trigger by rental properties now, or that we will benefit from this scenario, I don't want that to happen. I don't want to have a 5 to 6% mortgage rate. So what I want is a 7 to 8 mortgage rate for the next few years. It'll stabilize the market. We're not going to have, I don't want any frenzy, because it'll be catastrophic for a lot of Americans. The dream of the American dream is over if that would happen. So here's my take. So Richard, if you're ready, so I want to hear your take about my doomsday scenario for the housing market if the rate comes down to low. Doomsday.
Firstly, I like the clickbait about the current market crash and the reversal, because as we both know, there hasn't really been this big crash, although public perception is like, oh, rates are up and house prices are going down. But if you look statistically, and by statistically, National Association of Realtors, the federal government, real estate nationally is still up from where it was a year ago. I think actually it may be down finally like 0.6% nationally. So a negligible amount. But I think everything you said is everyone should really treat as the gospel, and they really need to listen to it. As you said, the smart investors are doubling down on real estate. And what's interesting is I've seen a whole new almost client base come in the last year or so as things have got less affordable and as rates have risen. And those are uber affluent people that have made tons of money on stocks and bonds and everything else, right? People that are worth $20, $30 million. And they're actually flooding to real estate right now as the safe place to put their money and the place that's going to offer growth. And look, it's common knowledge, right? And let's just talk economics 101. Okay. Let's really bring it down to a base level. Everything's based on supply and demand, right? And the reason why house values have gone up as high as they have is nationally, we have a home shortage in almost every major market across the country. And that home shortage, if they started knocking it down, is going to continue for the next 10 years, right? The problem is, though, they're not knocking it down. Every year, that number of shortage increases, right? And part of that is people live longer and new households are forming at a very high rate. And what has the Fed done, right? So they're combating inflation and they want to cool housing, right? And they say it openly. And that's what they've been saying, excuse me, the last year and a half as they have pushed rates higher. Now, what's happened is they've doubled and tripled the payment on a house from 2 years ago. Housing's remained robust, right? Even though the Fed came in with this external factor of interest rates and did their best to really curb housing and crush housing and then cool it down, they weren't able to do it. Yeah, did they stop 40 offers on every home? Yes, they did. But are there still 3 or 4 offers on every home? Absolutely. Absolutely. So what's going to happen on that same note, right? When the Feds start moving the rates down, as you alluded to in your whole presentation. So whether it's a year from now or 3 years from now, and whether we get down to high 5s or high 4s, right? Firstly, I think gone are the rates that we got spoiled with. I don't know about you guys, but I got a 2.5% 30-year fixed on my primary home. I'm never going to move. I'm never going to sell it. But those rates are long gone. I think the foreseeable future, I think if we can get to the low to mid 5s, that is a very awesome target. Keep in mind, as high as that sounds to some of you, that's 2.5% less than it is today, right? So what's going to happen as rates come down? All this real demand that was squashed down by this external force, the Feds and rates, once that real demand returns, and it's that demand, keep in mind, is created on the most basic fundamental of economics, supply and demand, right? That's why I stress on the real demand. Once the real demand comes back, because people need housing. So many of these new households have a wife, they have kids, but they're living at their parents' house because they can't go officially, for IRS purposes, formed a household, but they don't actually have a house and they need somewhere to live. So as soon as prices come down, there's going to be 50 buyers for every house again. And what happens when there's a high demand and yet still a low supply, because that hasn't been fixed, right? That's where money should have gone to, is incentivizing builders to build more homes, but that hasn't been fixed. So what's going to happen? Values are going to go up. Now, is it going to go up 30% a year? Like, I don't know. Maybe actually, if you look at supply and demand, but even if it starts going up 8%, 10%, 12% a year, that's a lot of return. So the smart investors are doubling down on real estate, doing everything they can to buy real estate right now because they know essentially what we just described, right? And they also know that they're not married to the cash flow numbers that they are generating today. They're just dating up. They're going to refinance when rates move down and create a more favorable position. And the rental market is as strong as ever because all those people that couldn't buy need to rent. So, yeah, we've been saying it obviously for a year and a half, and there's been a lot of doom and gloomers, especially early on, a year and a half ago when we were 6-7 months into this high rate market. Everything's like things are going to crash, and you and I were saying we don't think so, not from what we're seeing, just because there still is more buyers than sellers, not 50 more. But there's still 2 more, and there still is that fundamental supply and demand issue. Now, I didn't expect rates to go as high as they have, and I'm still a little surprised too that we still had national appreciation when we 2.5x the payments on a house. But what does that show to you? That shows to me how robust the housing market is. That doubling the payment on it has still not squashed demand enough to actually affect the housing market, which is nuts, right? If I tell you something, this product that I have in my hand is calculated to cost 2.5 times what it's going to cost today in 2 years. You would think I'm not going to sell a lot of these calculators, right? But guess what? There's only 10 of these calculators, and there's still 30 people that want it. Yeah, I agree with everything you said. I think this is a powerful and solid segment that we've covered.
Exactly. You sum it up. There's nothing more I need to say. And my quick takeaway is that in times of crisis, there are opportunities. If you are listening investors sitting on the sideline, now is the best time to get in. So just stay away from the doom and gloom, the naysayers, and all the world coming to an end, and the world is melting, as you said before. It's not happening. Look at the price long-term, invest for long-term for investors. That's my takeaway. Thank you so much, Richard. And this is Seewing. Thanks for watching. We'll see you on the next video. Have a nice day. Bye-bye.